All right, everybody. Hey, welcome to our Note Nation Top 42 as we roll into the capital of the states, Washington, D.C. We're talking about the WC market this evening here. I want to thank you all for joining us live and those that are watching this on the replay as well. Hopefully, they walk away with some great information and that you can apply to your market. Like I said, we are on the Note Nation Top 42. This is market number 7 out of 40. So we're just over a week into this and excited at the amount of people enjoying us, learning, and hopefully you take advantage of what you learned tonight to apply it to your own real estate or your own investment in the near or distant future. Once again, we've got a variety of local and national investors from all across the country. Join us, not just people there in the capital, but also around Virginia, Maryland as well tonight. Existing real estate investors, we've got new investors looking for information on the market, what to do, what not to do. We'll be discussing some of the current statistics and numbers. We'll talk about the second half outlook of 2020 for all of you guys and into beyond, the future opportunities. Well, what opportunities will lie in the new year as we get through the second half of 2020. And then obviously we'll discuss also where and when to get started in applying what you've learned tonight and applying what you can obviously start making some money. Who doesn't want to make money, but also create a lot of good for people out there for you. So hopefully you're rocking and rolling along. Hopefully your evening, you sit back, we'll be in and out here less than an hour for you guys so you guys can enjoy your evening. So once again, everybody, I'm Scott Carson. If you guys don't know who I am, I've been an active real estate investor for over since 2002, not quite 20 years yet, but I got a heavy background in finance, mortgage, banking, and the debt markets since 2004. I've purchased over $500,000 in debt in residential and commercial real estate. I'm the CEO of WeCloseNotes.com. I've been teaching real estate investors how to capitalize on a variety of market trends. I've been, like I said, been actively investing since before the turn in 2008, but dating back to 2004. So how people could take advantage of foreclosures, how they invest in short sales, how they invest in a whole variety of facets, not only just investing, but also getting started, because a lot of people need help with just the basics. And I pride myself in helping people out with that. I'm the host of a small little podcast that's pretty popular out there called the Note Closers Show that's syndicated across the country. I invest all across the United States, but predominantly in roughly about 30 different states. And I love Austin, Texas. Austin, Texas home, but I am an avid baseball fan. Been to several Nationals games, hence why I'm wearing the Washington Nationals logo. Hey, congratulations on them winning the World Series last year. It's a big boost for the DC markets. It'll be interesting to see what happens with the NFL team changing their logo or their name and mascot here in the next few days as well. But anyway, we're here about to talk about what's going on in the market here. And why am I spending time on my evenings for the next couple months doing this to help share with you guys? I do it for my own health. Well, yes and no. I love helping investors. I really do have a passion for helping people. It is actually me helping people is one of my 5 love languages. I like to solve problems. I like to help people solve issues. If it's not me, how can I refer them to the right person out there to help them solve it? The right person, the right company. I do believe we are in an opportunity phase, not a, oh, woe is me phase. Yes, we've had some hiccups. Yes, we have some people facing some bad issues. We'll get into those numbers. But I do believe this is an opportunity that only comes around once every 10 to 20 years, that if you take advantage of what's going on right now, not only can do a lot of good for yourself, but also do a lot of good for the people around you, the communities, and America. And I would tell you this, I'm passionate especially about what things are going on here, because I was once a distressed borrower. Going back to 2002, 3, first got into real estate, I was upside down, was working fine, lost my job. I was like many people who was out of work and could not pay my mortgage. And so I empathize with the the millions of people out there that are out of work and struggling to make their mortgage payments right now. All right. And it's part of the reason I'm so passionate about helping people is I had some people help me out of a bad situation then. I learned, and I've been very blessed along the way through ups and downs. And there is nothing greater, I will tell you this, hopefully you guys all agree with me, there's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they thought was once impossible. We still live in the land of dream and opportunity, everybody. I don't care what state, what city you're in, there's a lot of opportunity to take place. And if you've got some big goals, there are some ways that you can make those things happen. And hopefully, if you're joining me for the first time tonight, this is the first hour of your journey, your transition into making some things amazingly happen, not only for yourself, but your family and future as well. And I have set a big goal. I always talk about having a goal. I have a big goal of helping 10,000 investors in the next 12 months really do some amazing things with their real estate investments with the market, giving us a lot of opportunity right there. So yes, 10,000 investors in the next 12 months. By June of next year, by July of next year, yes, got some big goals. So let's talk about what do the national numbers say. You know, the national numbers, are they rosy? Maybe not. Actually, in some cases, downright damn scary, okay, out there for you, everybody. So 11.1 unemployment rate in June of last year. July's numbers aren't out yet because we're not through July, but 11.1%. Basically, 1 out of 9 Americans are unemployed. That's the national average. It's high in some areas, lower in others. Altogether, there's 17.8 million people currently unemployed. It got a little better in July, okay? But 17.8 million Americans are unemployed out there. That's a scary number. Obviously, we'll talk about some other things. They expect 52% of small businesses to fail. Now, if this thing continues to carry on in other places, it may be a higher number than that. But the sad thing, before all this kicked in March, 1 out of 10 Americans was already struggling to stay current. 1 out of 10 was already struggling, was roughly about 30 days behind their mortgage already before things get into it. Not just not rents, we're talking about mortgages. So that is a sad thing. Now, that trickle-down effect affects people in the rental space too, and we'll get into that later on. But right now, the most recent and up-to-date numbers is the national mortgage default rate, delinquency rate is 7.76%. Across the board through Fannie Mae, Freddie, government, and then also your traditional mortgages, 7.76% of Americans are already in default. Yeah, that's scary. Now remember, going back to 2008, all the banking models like, oh, we'll never see 8%, we'll never see 8%. Well, you know what? We went back past 8%. You know what? We're going to go past 8% again. All right. There are currently 4.1 million Americans currently in default. Okay. 4.1 million Americans currently in default. And let me give you a little bit of a number why that's an important number. If you look back to 2008's numbers, from 2008 to 2010, we went from 0 to 1.6 million defaults. It took 18 months to hit that. Well, we're 2.5 times that, and we're not even, well, we're in 90 days from really when everything kicked, oh, sorry, maybe closer to 120 days from when everything started to hit the fan. So this is why I say we're going to exceed those numbers. Yeah, the government may have kicked the can down the road for 6 months, and other places may be kicking the can an additional 6 months. But at some point, somebody's got to pay the piper. And that's where you have, yes, is it a good thing that we're helping people out? Yes. Do we want mass evictions, mass foreclosures? No, we don't. That would be a kiss of death. But there's still going to be a lot of those things that happen. So you can't look at these numbers and just say, oh, everything's be okay. No, everything is not going to be okay. Everything is not going to be, hey, it's a need some. And as you look back at some of the numbers, this came out a little while, actually about a month ago, that in June, we saw a record highest spike in 2 years in mortgage loan delinquencies. That's not a surprise, okay? But when you look at the numbers, the non-prime market, which we've had non-prime, yes, that's subprime. This is, well, it's not subprime. It is subprime, okay? For all the lenders doing 100% financing, for all the lenders dropping FICO scores down to the 500s and then paying the down payments in the FHA loans and then paying not only the down payment, but also paying the closing costs. We've had a lot of people get into houses that probably shouldn't have been, as the banks have gotten greedy. It's a repeat of 2008 all over again. We saw a 21.8% spike in non-prime loan delinquencies in June. I think that number may go up again here in July. We've seen a 12.2% increase in expanded prime loans. Reperforming loans saw 6.4% increase, and whole prime, all prime loan delinquencies rose just 5.5%. Yeah, better credit, they're going to have less. They've usually got some savings. They've usually got some reserves. But this non-prime stuff, people are barely getting in by the skin of their chinny chin, everybody. And if they ain't got their job, if they're counting on overtime and their overtime's been cut down, their hours cut, they're going to have to start making decisions on, do they pay the power? Do they pay to put food on the table? Or do they pay to keep their house? And we all know how, which way and who's going to rank what on that totem pole. So let's dive into Washington. Let's dive into a little bit of a macro level for Washington State. Washington, D.C. area for you guys, okay? Now, here's the thing. The beautiful thing, sorry, 21 of 22 area counties had unemployment rates lower than the national average. That's a beautiful thing. The United unemployment mark, you can see, is roughly about 4.5%. I just pulled this off the Labor Board of Statistics across the country, 4.5. DC, though, had a 5.9% unemployment rate. And you can see the county, PG County, 3.6, Fredericksburg, 3.7. All kind of went down the way a little bit here. All right, that's a good thing. But that is a little scary, because when you flip it up and we pull it exactly into DC, you can see 5.9, District of Columbia is greater than the national average in a lot of the counties. Let's talk about that. What does that fall into? Washington area, Alexander, you can see here the default rates on, this is unemployment rate, not default rates. You can see the default rates, 5.9, District of Columbia, once again, those numbers have increased pretty much across the board, a little bit each month. Let's see here. District of Columbia went from 5.6 to 5.9. These are the most recent quarterly numbers. Arlington went from 2.1 to 2.2. The only one that went down was Clark County, 2.9 to 2.8. Everybody else saw an increase in unemployment. Now, if people are unemployed, what's that mean? Well, that means they can't pay stuff. So if you look at the foreclosure numbers, now this is a little skewed because they haven't really had any foreclosures take place, but you can still see foreclosure trends taking place. And if you look at roughly the Washington, D.C. market, zip 20012 is the highest, with 1 in every 2,100 homes, and then down to 2024 is 1 in basically every 8,000. So, you use the mixtures between the haves and the have-nots, the highs and the lows. And I believe Washington's like any other major city, you're having much more of a clearly divided haves and have-nots, because if there's not a lot of light blue, I mean, there's a lot of light blue, there's not a lot of that middle blue. It's all either dark or light. And you look at the numbers at the pre-foreclosures, obviously this is most recently for May. Prior month was up 400% in pre-foreclosures. Auctions were up 700%. And bank owns were up 150% over the last month. You look at kind of the drop-offs. It dropped off obviously dramatic in foreclosure activity in April, but it's already started to back up in May. And when the new numbers come out from Realty Track, I think we're seeing an increase as well. Now, they just did an article. Adam Service, if you don't know who Adam is, they're ATTOM. They're a company that tracks mortgage numbers, default numbers. They do a lot of great stuff, especially for banks and institutions, okay? And there's basically, they've been outranking, all right, of the top 50 counties in the country that are going to have the biggest effect, okay? And Adam Data Solutions, this just came out just a couple days ago. Fresh, what is today, the 13th? Today's the 13th, so this came out 3 days ago. This came out on Friday, all right? Those are going to be hit the hardest, okay, with clusters that are going to be really difficult are going to be, you're going to see clusters in the New York City, Chicago, Baltimore, and Washington, D.C. areas. On the East Coast is going to be hit harder. And it also says that you look at 4 counties around Baltimore, 5 around Washington, D.C. Those are the ones that are going to be hit the hardest here. Now, what does that mean? You look at here we go. 5 counties in and around Washington, D.C. metro ranked in the top 50 at most at risk, including Charles, PG, and Frederick in Maryland, and Spotsylvania and Stafford in Virginia. 4 were in the northeast part of Maryland, Baltimore, Carroll, Cecil, and Hartford counties. Okay, those are going to be the hardest areas as things shake out here based on Adam Data Solutions. And I like Adam Data because they're always looking and kind of put a little predictive about it. It's not to say that everybody's going to be struggling, but you can see if default rates keep going up, unemployment rates keep inching up, obviously default rates are going to start escalating. People can't pay to stay, okay? Let's talk about some of the foreclosure numbers. Here's a number that I mentioned earlier on average across the board at 7.76%, but you see the FHA loans, 9.69%. Your VA loans, 4.65. Obviously, DC, Baltimore, area, Alexander, VA have a lot of veterans in that neck of the woods. My niece lives in there, and she's a VA from the Navy. All loans together about 4.36%, but you can see these two, the VA and the FHAs, are going to increase that default rate, bring that average up. Obviously, somebody who's gone out and got a conventional 30-year, fixed rate loan, you're still seeing a smaller default rate, but you're still seeing a lot of people impacted. Now, who knows what's going to happen with the elections? Obviously, DC has always been kind of a 4-year to 8-year cycle as people move in, as people get elected, unelected, or voted out in a variety of different fashions. But look, I only tell you this because it's a scary time for some people. This represents your first-time home buyers. And what you have, not just defaults on the mortgages, you're going to see a lot of tax defaults. People are not paying their property taxes. All right. Now, it would be great if everybody was able to have a forbearance agreement, and a lot of people on those government loans are doing such that. All right. We are seeing in June the count actually went down a little bit on forbearance numbers across the country, went down by 57,000 or 0.1% from the previous week. But we're still seeing roughly, 4.5, 4.6, 4.7 million Americans forbearance plans. Now, Fannie Mae and the government have already said, hey, you're not going to be due for your 90 days or your 6 months when the forbearance plan ends. We're just going to tack that on the end loan. That's a good thing. That gives people opportunity. Okay, great. I'm not going to be due for 6 months all at once. I can get my feet back on track. But if the unemployment rates keeps increasing, hey, those forbearance plans are only going to be good for a while. Okay. Now, is this good news or bad news? Well, it depends on how your cookie crumbles, I guess you could say. Now, we all know that roughly about 1 out of 15 borrowers are in default there in the area. DC is higher than the national average, 13th highest when you compare it to other states as far as default rate. It's the 13th highest out there. Okay. Now, one thing that's going to drag this out a little bit is that on the Fannie Mae FHA foreclosures, Washington, D.C. has a judicial foreclosure time frame about 690 days. That's going to push defaults and foreclosures out because it's going to take some time to clear it off, get some people's housing. But when you have a backlog of forbearance agreements, 6 months, and then you have a backlog of default and sporadic defaults along the way, it's going to put a bind on the court systems. We all know that. Okay. So it's going to be a while if you're a residential realtor or a residential investor looking and who have bought REOs or fix and flips. It's going to be a bit of a tough time. You have to wait around 12 to 18 months, if not longer, before you start seeing foreclosures hit your market. So what does that mean? Well, there's still going to be a lot of opportunity. Do you want to sit around and wait 18 months? Or do you want to learn how to start doing some things now? Let's talk about commercial debt. A lot of the commercial property has been hit. Obviously, we know that rents have gotten ugly with major chains not paying any of their rents. We know that we're going to see an increase in rent signs. We know that a lot of the smaller businesses, the mom and pops, are the ones that are being hit the most, at only 52% or greater, that number increasing on a month-by-month basis, depending on the area you guys are in, is increasing. We all know commercial real estate's been in a boom. We've talked about this for a while, but we're going to see obviously a lot of vacant for rent signs that lead to a lot of opportunity. So let's talk about some of the commercial default numbers. Right now, hotels across the board, we know there's plenty of hotels in the DC metro market are in default. 1 in 5 in default. 1 in 10 retail loans are in default. You're going to see office vacancy increase to almost 20% by the end of the year, if not already there. You're going to see a 15% vacancy rate for retail and restaurant spaces. We all know retail has been in default for quite a bit of time. We all know restaurant spaces have also taken a hit. Now, there's a talk, oh, yeah, restaurants will recover because of new restaurants that come in, they can buy. You're going to still see 15% or more restaurants vacant, if not out of business. Okay. I expect us to see the boom of the food truck. Seriously, the boom of the food truck here in the end of this year and the beginning of 2021. Now, the thing is also going to be difficult is that rents, you have to expect rents across the board to decrease at least 10.5% by year end, if not more. So if you're going to buy office space, who are you going to put into it? Well, you're going to have to cut your rents to try to find somebody. And if you do buy a spot and the tenants in there aren't paying, what are you going to do? You're going to keep them in there, or are you going to evict them and try to find something else? You're still going to see increased rents falling. So that's the thing to look at. If you look at your existing rents now, figure that it's probably going to need to be at 80, 85% of that, of what that market rent was going to be in the new year. Okay. We all know what's sad is delinquency rates have tripled in the U.S. commercial mortgage market. At the beginning of March, when everything started to hit the fan, we had $50 billion in market lost in March alone. Okay, we all know the commercial space, especially when you look at anything around tourism, hotels, motels, short-term rentals and the Airbnb side on the residential side has been struggled. You're seeing a lot of people like, what am I going to do? And don't be surprised. You start seeing a lot of hotels for sale in the capital markets. Okay. There's an article here that came out just recently last month on this, talking about the commercial mortgage-backed security market. There's a huge increase of these things. The banks over the last couple of years have been really gobbling this stuff up and originating more of this distressed debt. Okay. You're going to see that they issued roughly 21%. You're going to see that there's a lot of opportunity, though. Do I have that? Oh, did I not have that highlighted? I thought I had it highlighted. I'm going to have to go back here. Just that a lot of this stuff is going to be available for us at the bank level, not just the bigger guys buying. Your local banks, your national banks have bought some stuff out. And while the banks have a little bit of time to kick the can down the road or pretend and extend mentality, the more somebody's not paying in the business, the bigger discount or the bigger problem is the bank's bottom lines out there. And the biggest step is if you're buying some of this stuff is to step in and work out as best you can, whatever you can with your existing tenants. It's going to be often the better aspect versus evicting and trying to find somebody new. If you've been in the commercial market space, you've heard of billionaire Carl Icahn talking about what's going on in the market. He mentioned this back in March that the commercial sales market is going to blow up, which obviously we saw happen in March. He's been shorting a lot of his commercial stock. He knows it's going to be worse than 2008. He goes, you can buy back a lot cheaper. A lot of the shopping malls, office buildings, hotels, and retails. Basically, that's where the biggest plays are going to be when it comes for properties and that stuff. And then where are the opportunities? Well, opportunities are going to lie not in that bigger space, but honestly, in that smaller commercial space, $2.5 billion valued properties or less. I thought I had an article. I saw an article somewhere that I was reading. I was like, oh, it makes a lot of sense because the bigger 5 million plus are where all the funds and the banks and the big institutions want to be. But below 5 million, there's a big gap there for investors like you and me. Now, where the opportunities be foreclosures or REOs, if you want to wait around for a while, by all means, sure. But I don't think you want to do that. By the time it gets to there, it's going to be gobbled up because it's the lowest price in the totem pole. Can you buy fix and flips right now? No. Sorry, no. And if you could, all the money is drying up that people have been lending on that fix and flip side. It's gotten a lot more tighter on the lending criteria for mezzanine lenders, hard money lenders out there. Do you want to be in the rental space? Probably not right now. As we see, now don't get me wrong, on a lot of apartments and some of the things they've seen, roughly an 85, 90, 95%, depending on who you talk to, collection rate, which is great. It all depends on the quality of your clients. The A's and B's have done really well. The B's and C's have done okay. The C's and D's have the higher the percentages of defaults. Now, the real opportunity for investors here in the next 6 to 12 months is going to be in the debt game. Residential notes, we're going to start seeing some of that in different parts of the country, if not in DC area. Others at banks at the end of the fourth quarter, they want to get stuff off their books. And if they think the forbearance agreements, the borrowers aren't going to be able to achieve and get back on track, they're going to be looking to sell stuff off at the end of the quarter. Banks have been starting to save in their reserves. I've seen this by tracking this stuff, that the more reserves banks are stockpiling means for bigger debt sales at the fourth quarter, the first quarter. We're going to see, though, commercial notes already starting to come to play right now. Commercial debt markets, people already moving. I've talked to someone that said, I've seen more deals in the last month than I saw of last year. And there's a lot of people actually buying commercial stuff and pivoting on what they're doing. Here's a great example of a developer built this hotel in Arlington, Illinois. All right. You know what he did? Instead of trying to turn it into keep it as a hotel, he turned it into an apartment complex and expects to sell the whole thing out. Beautiful. I encourage you to go check out One Arlington and see the Yelp pictures. Done a really good job turning into 1 and 2 bedroom apartments. We've even got one of our buddies, Garrison Gilbert, who's out of the Baltimore, DC area, doing this in Gettysburg, Pennsylvania on a property, taking a 55-unit hotel and turning it into 40 2-bedroom apartments. And there's a lot of opportunity. If somebody's vacant, but you can pivot it. If there's a big box store by itself that you can pivot into a self-storage facility, great. If there is a store that you can turn into a big office building, you can turn it into executive suites. That's a great thing. There's a lot of opportunity there because a lot of companies, bigger companies, have sent their workforce home and don't expect them to come all back. They expect only a fraction of large office buildings to actually get rebooked backed up. So I'll give you an example here in Austin, Texas. There's quite a bit of office space. We all know that also in DC. There's only a lot of opportunity. You're either going to have to pivot and get creative to fill those spots. You no longer have somebody come in and rent 5,000 square feet. They might rent 500 these days, or 50 square feet. So let's talk about some of the banks in trouble. Now, one of the things that we like to do is I like to look at Bauer Financial. Now, Bauer Financial is a bank rating agency. And what they do is they look at numbers, they look at the banks, what they filed with their FDIC quarterly reports, the reserves, their net losses, defaults, and rank them. And we like to pull the report for banks that have 5 branches or more. And it's a lot of banks that have 5 branches or more across the country. And what I did is for this webinar, this video, I looked at, so let me filter it down for those banks that are just in Maryland, in Virginia, and then DC. Now, there's only one bank that actually has their office is based in DC. The others are all around. So basically 76 are in Maryland and Virginia, one's in DC. But between these 77 banks that have their offices in those 3 areas, of course, they're lending in other areas, but out of them, they have $2.9 billion in loans that are already 90 days in default. 2.9 billion with a B, everybody, that are already 90 plus days past. That's a lot of opportunity. Now, on average, across the board, all 77 banks, it's about 5.1% average of each bank's loans are at least 90 days past due. 5%, okay? Now, out of that 2.9 billion, 1 billion of it, a third of it, just over a third of it, is in single-family homes. 1 to 4 family, single-family homes in default. Now, couldn't tell if they're all in the DC, Maryland, Virginia area, but they've got stuff on their books they're looking to move. They've got stuff on their books that's in default that they're going to have to do something with. Some of it's government-backed, others of it's just traditional-backed. Okay? The 2 biggest contributors to this is HSBC and Capital One Bank. Now, you're probably not going to go buy a one-off note from HSBC. You're not going to do it. They're going to sell in 50 million tranches. How do I know this? Because I've talked to them before. I've talked to their trading desk. Capital One, hey, what's in your wallet? It's a mortgage that's not performing, okay? Between the two, it's almost neck and neck. They had over $800 million in single-family loans in default between the two of them. Now, Capital One, I bought a lot of commercial debt from them years. I have bought some HSBC debt on the commercial side as well. Now, another one, which is kind of surprising, is Industrial Bank. This is the one bank that's actually focused in DC. It's based office in DC, off the Bauer Financial Report. They're really in trouble. They only have 10 branches, but they've got a 19.4% default rate. 4 times the rest of the bank's averages out there. And that's a scary thing. So if you're targeting somebody, you may want to start looking at the foreclosure numbers here in commercial and the residential here in the next 60 to 90 days. And I guarantee you're going to start seeing Industrial Bank or one of its trustees pop up in the foreclosure route. A lot of opportunities there, okay? A lot of opportunity there. I mean, they're not the biggest bank, obviously. They're not the biggest Capital One HSBC, but they're in trouble. And they could use some help moving some stuff off there. So why would you want to invest in distressed debt? Why would you want to contact the bank, special asset manager, secondary market department, and say, hey, let me see what kind of debt you have? Because there's some opportunities. You can start buying that stuff now versus waiting for foreclosures. And the closer you get to the foreclosure auction, the more expensive that debt is going to be. When you start seeing people get beyond the 90 days, especially the 6 months or more in distressed debt, debt becomes very discounted. I mean, there's hotels, $260 million loan on a hotel in New York City that they're selling for less than 20 cents on the dollar. $260 million loan, they're selling for less than 50 million. That's a big discount. So you can often pick up some good assets. And if you've got 6 months of reserves or you got some time to work through this stuff, hey, it can be really an advantage. You can buy some different discounts, and depending on where it's located, if it's got a longer foreclosure time frame, which DC does, which Maryland does, Virginia's a pretty faster foreclosure state, but you can often pick up some deals, and as you're working through things, work it out with the borrowers, take over receivership if there's a commercial loan, and really be able to pick up a deal that you've never gotten before. And there's a lot of strategies: loan reinstatement, modification, short sales, short payoffs, foreclosures, loan sales, deed in lieu, cash for keys. You can do a lot of that with the residential debt, but the beautiful thing about the commercial debt is you have the right to take it over in receivership in your foreclosure and start collecting the rents and negotiating yourself with the tenants, okay? Taking it over and turning it into a cash performing note. For cash flow, if you're buying a debt at a discount, you've got a lot of flexibility in what percentage of rent you can accept. You got a lot of moving parts that you can make happen in your favor. Drop the interest rate, drop the rent rate, stair step the rent rates, helping people really overcome obstacles out there, or take over the property if you want it and operate it yourself. Take it over yourself and put something in there. A lot of people have made a lot of money in the downtimes. You look back in 2010, 11, 12, a lot of debt was sold. People bought it cheap and then negotiated and did really well on the commercial space and the commercial markets. Same thing is happening right now that you all can take advantage of. Some other advantages, note investors. You're not going to, if you're investing in real estate or investing in notes, you're not going to be one of these guys or gals out there who's sending out postcards, direct letters, door knocking. No, we don't do that on that aspect. There's nothing against that, but if you got to send out 5,000 postcards and you're hoping to get 1 to 4% response rate, that's a really low response rate. If you've got emails, if you can jump on LinkedIn, you can dial for dollars, there's ways for you to make a lot of money and you don't have a lot of heavy overhead. And that's the beautiful thing I love about the note business. If you get a hold of, say, Capital One, my relationship with Capital One over the years has been $1 million relationship with lists that come every quarter that I can cherry pick from. All right. I don't have to try to squeeze a deal in to my particular area or have one exit strategy. I got a variety of different deals I could look at. Okay. I can cherry pick the best deals for my portfolio. If I can buy in bulk, 2, 3, 4, or 10, 20, 30 or more, depending on what type of portfolio we're looking at. The pricing gets better when you can buy in bulk. And you can do this with residential commercial assets across the board for the most part. You're not going to buy residential one-offs from some of the bigger banks, but that doesn't mean there aren't a million other banks out there with debt on their books you're looking to get rid of, whether you're looking for stuff in and around the DC area, the Maryland, Virginia area, or other states out there that are better pricing. And if you don't have the money, the beautiful thing is you can raise capital from other investors to fund the purchase. The banks don't care where the wire comes from. They don't require you to have earnest money. They want just a wire. Can you find? Okay, great. And there are plenty of investors out there to fund your deal. If you think about this, guys and gals, in 2010, 2 years after the market crashed in the last time, there were 15 million homeowners underwater and millions of commercial real estate and distressed debt as well, too. We're going to see that happen as well. We're going to see at least 10 million, if not more, defaults across the board. Now, the question people always ask me, well, Scott, I'm brand new. I don't know how to approach investors. You know what? It's pretty relatively easy. Raising capital isn't difficult if you know what to do and know where to look. And if you guys are wondering if there's investors in the DC market, I'm here to tell you, it's a very investor-friendly market, a target-rich environment, I guess you could say if you're a hunter. There's $9 trillion roughly in retirement funds out there across the country. In DC, there are 96,000 investors. That's just Washington, DC, roughly area. 96,000 investors with an IRA of some sort. Now, out of that number, there are 66,000 people with an IRA with at least 150 grand or more in their accounts. That's a lot of money sitting on the sidelines, probably not making more than 2-3% for the most part, maybe 0% for the big thing. They're looking for somebody to help them put their money to work. They're looking to get an above average return. They're looking to get better than their certificate of disappointment. Okay. And with a lot of the stock market being up and down, people have a lot of 401ks that are now 101ks that we won't even talk about. Okay. There's also a lot of investors in the DC market, roughly about 58,000 in the metro market of investors looking for deals. You can just be a deal strategist, putting deals together, building an investor list, going out and networking and identifying other people that are looking for deals. You go find the debt and the deals, boom, I bet you can find the investors to make things happen. If not, the investors not only to buy your deals, but also fund your deals as well. And the question I'm going to ask you guys here is, do you want to be the banker or the borrower? You don't want to be the borrower. You want to be the banker. An investor that goes out and gets traditional loans, they're a borrower, and they're facing issues right now because the bank always wins everybody. And I would much rather be the bank to make some things happen. I'm sure you guys would. All of us that are watching this, we all are in the paper game. We're all in the debt game. If you've got a mortgage, a loan on a car, student loan debt, credit card debt, whatever it might be, you owe Uncle Bobby down the road $5,000 as an IOU, you're in the debt game. You're just on the wrong side of the payment stream. It's going out versus coming in. You want the debt payments coming in without all the issues of toilet stands and trash outs. You want to be able to be the bank not the person who's got to pay every month. So how do you tap into the tsunami of deal flow we know we're going to see in the next 6, 12 months or sooner, depending on what state you're investing in or what market you're investing in? Well, I've been teaching investors about notes since 2010. I was the Educator of the Year, runner-up another year in the real estate field for what I do. And I guarantee you nobody gives you as much education as we do. Tons of information with our podcast, tons of information on YouTube. I've helped thousands of investors purchase their first non-performing note. I actually got a text message from a guy on Facebook today. Says he's listened and took our one-day training, bought 2 notes, and he's raised another $500,000 in notes for his own portfolio to fund deals with. I love that. If you're looking for residential, commercial notes, whatever your flavor is, whatever you're passionate about or comfortable with, there's opportunities out there. Whether you're looking for cash flow, be on a consistent basis to build wealth, or asset growth, to do whatever you want. If you're rentals and you want to use notes to find more rentals, by all means, you can do that. You can buy one-offs or you can buy in bulk. It just depends on what you end up marketing, how much capital you end up raising. And we've seen trades anywhere from 25 grand or less all the way up to 5 million or greater. Smallest trade, 1 note. Biggest trade for me was 185 notes in one portfolio. It's going to take some vendors. It takes some servicers. It's going to take some people to help you with that deal. But the beautiful thing, everybody, there are a lot of teams and a lot of vendors out there to help you. It is a service-oriented business so that you can focus on finding the deals and raising the funds. You don't want to be doing the workouts. There are people out there to help you out with it. And no, you don't need credit. Don't need your own funds. As I've said before, bank doesn't care about your credit line or your credit score. They don't care where the money's coming from. They just want to get paid in the wire, okay? And as I said before, you don't have to have a lot of real estate experience if none. If you've got a LinkedIn profile and don't mind sending out or dialing for dollars or sending emails out to some lists that we show people how to build, you can do this business from anywhere in the country, okay? So whatever your focus is, whether it's single family homes, apartments, hotels, retail office, self-storage, mobile homes, medical office, there are deals in all asset classes out there, everybody. You just got to figure out what you want your focus to be and go after the banks that are lending on that stuff. And that's one of the things. I show you where the target is so that you can create not just win-win stories for you and the banks, but also win-win-win for you, the banks, but most importantly, the borrowers out there that are facing trouble. Those borrowers out there that are in trouble, they're not bad people. Most of them are really great people that just are been dealt a shitty hand. All right? They've lived in their houses for a while. They're trying to keep their businesses going. They didn't expect this like anybody else. They didn't expect the state homeowners to go for 60, 90, 120 days. People getting sick, out of work, being quarantined. There's a lot of bad things happening to good people. And I believe it's up to us. That's why I have a goal of helping create 10,000 note investors in the next 12 months to really take advantage of the situation and help us really solve the issues at hand. Just like William and Sheila out of Illinois here is just a classic example. Lived in their house for 18 years, market appreciated. They took a loan out, pulled some of their equity so they could pay off some of their credit cards, do the repairs of the house. Bam, market crashed on them. Bam, he gets sick and has a heart attack. They were trying to do a loan modification for 4 years when I bought their note. Bought it at a huge discount. Immediately saw that they've been trying to do a loan mod, so all the paperwork involved. Immediately reached out to the borrowers, was able to negotiate a loan mod on their loan to keep them in their property instead of it being another 30 years of paying on their mortgage. They now have the house paid off in 7. With their existing payments, maybe paying a little bit extra each month, but we really work wonders in the debt game. There's nothing more beautiful and fulfilling than being able to help an investor out or homeowner out. That's a really good thing when you can sleep at night well because you did some good. And that's what we need. We need investors like you guys that are watching this right now who want to do good, who want to help others out there. We need you. We absolutely need. There is more than enough to go around out there. More than enough inventory. And I'm just talking about this one market. Think about all the markets across the country that are struggling right now. A lot of them. You can do it big or you can go small. Whatever you want to do. You could be like Gene, my buddy Gene from Elkhart, Indiana here. Started off very small, buying 1 or 2 notes every couple of months with his own funds or his profit until he learned the systems that we teach and learned how to raise private capital. He got it out of his own way. And fast forward now, 4 or 5 years later, and he's bought over 100 assets. He's got over 13 million in private funds in the market, making 7 figures. And he texted me that the other day, said, Scott, thank you so much for what you taught me and how you taught me how to do it. Revolutionized my business and my life. It's a beautiful thing. And then the same thing with Laura Blanc. She's one of our rock stars who just moved actually to Maryland, to her dream home that she's always wanted to move from South Austin, Texas here. She's done a great job, like many investors, hustling, trying to do anything. Took too many workshops, trying to do a little wholesale, trying to do a little private money, a little slight rehab, all right? Trying to make some things happen. And then she discovered the note business, realized, oh my gosh, I don't have to fight all these other crazy investors out there. I can move upstream, move to the front of the line, 6 to 12 months ahead of everybody else. And she did that. Bought a couple of notes to her first funds. At the end of the first year and a half, she bought by the second year, she closed on over 75 deals. And now she's getting ready to close on a portfolio of 100 plus notes, performing loans at 53 cents on the dollar. Performing loans, 53 cents on the dollar. It's a $4 million purchase. We're so excited for her when she closes on that deal. Life-changing, not just for her, but for her sons. That's a portfolio she can hold on to for decades of performing paper. They can pay the bills and allow her to do what she wants when she wants. Kind of like our buddy here, Keith Collins, out of Ohio. Keith has worked in city government, been an entrepreneur for years, done some dabbling, fix and flip, stuff like that, but really took to the note business. And he messaged me just the other day to say, hey, Scott, thank you so much for helping me. I'm going to make over $1 million, 7 figures this year, based on the deals that I'm closing, and I couldn't have done it without you. Without you teaching me and showing me the ropes how to get started. And I love that. That's great. I love it when I help people take their business to the next level. And then you know what? The banks don't care what color you are. They don't care how old you are, just that you can close and make things happen. And that's why I'm so proud of our next student here, Rafael out of San Diego, young guy, mid-20s, been a business owner in San Diego with a car detailing business that he had to close down. He had to shut it down. He had to let his 15 employees go over the last 90 days. And I spoke to him recently, and he started taking our training back in December and has done an amazing job. Bought 2 deals immediately in like the first 2 weeks. First month and a half, he closed on 5 deals. The first 2, he got reperforming at above a 15% cash on cash return to him. The other 3, 2 of them, he's got pending sales where he's gonna make about a 20% cash on cash return on those 2. Third one, or the 5th one, still working through it. But he says, Scott, I'm so happy I did something different. Otherwise, I'd be stuck in a lot worse situation, because I want to help people. And he's also doing a great job. He may have funded several of his own funds, but he's gone out and started raising capital, started sharing what he's doing to local investors, his warm market, and people like, oh my gosh, seeing the activity and seeing what he's doing. We're not talking $200,000 homes. We're not talking $100,000 homes. We're talking he bought a couple 50, 20, 30s and made some great deals. It's all about return on investment and the paychecks coming in. And he's doing an amazing job. And we're so proud of what he's doing. He's going to do some bigger things. So I don't care what age you have, what experience you have, whether you're male or female, black or white, Hispanic, Latino, Asian. I don't care if you've gone through the big D, and I don't mean Dallas. I don't care if you've been divorced or struggling, been laid off. You know what? You can either sit there and curl up in the fetal position and cry and whine, or you can dust yourself off and go help people. You can go make things different out there. For like so many investors that we've helped, making America great again, one default to borrow at a time. We're so honored in the many students that we've helped over the last few years to do some big things. Hundreds and hundreds and hundreds of students who've bought debt, not only for their own investments, but also use other people's money to fund the deals and really make it a win-win across the board. Win for them, a win for their investors, also a win for the borrowers, and they bought the debt and worked with them. And how do you learn that? Well, many people, I know money's tight right now in a variety of faces. So we've got and put together a 1-day note training event called Note Weekend. It's a great way for you to dip your toes in the water and see if the water's warm for you, if you like it. Not a big investment. Tuition to this is usually about $99. We have dropped it down to $49. It's on a 3rd Saturday of the month called, if you go to noteweekend.com, you can see the most recent schedule for it. And you also see what we kind of cover in our Note Weekend training. So 1 day, just yours truly. We do record it, so if you can't make it, you can always watch the replays. But like I said, it's a mini workshop. It is a great way for you to kind of learn things. It's live through Zoom on Saturday. We share the replay so you can restream it on Sunday. You can download the replays if you need to take them with you. Our students like to have taken, say, it's the Cliff Notes version of note investing. And I got through college on Cliff Notes, okay? It is not meant to be all, learn everything in 1 day about note investing. That's not going to happen. That's more with our 3-day, but also of your first few purchases. Notes for your own portfolio. So, like I said, it's $49. We run for usually from 9 a.m. to 3 or 4. Depends on how many questions we have. We have a networking out of the last hour for people to kind of interact and help them build their networking aspect of things. Noteweekend.com is the website. Like I said, it's usually the third Saturday of the month. I dedicate that so that you guys can get rocking and rolling. You can start learning. And like I said, if you miss a spot, you can catch the replays. Or if you can't make it to a specific weekend, you can always go back and we can bump you the next month. So what do we cover? Well, we cover the very first day, first session, how and where to find notes. How do you find the banks? What places do I go to pull lists from that you can set up into an email blast out or connect with people online? How do you fund these deals is the next biggest question. Not only just finding them, how do you fund them? And we're an expert at raising private capital. We show you how to tap into local investors or how to find local people that are looking for deals that want to fund your deals. Okay. We talk about the different exit strategies because there's roughly about 10 different exit strategies on the residential or commercial side of the debt business. And there's profitable strategies. Okay. Everyone can be profitable in a variety of ways. You just need to know which way the deal is going to flow. And we also talk about that you're not in this by yourself. You're not the one making the phone calls to the borrowers. You're not the one negotiating that. We show you how to identify and hire the different vendors that you need to make things happen. We also show you how to raise the capital and have the deal, your due diligence or your legal and other things funded by your investors because you're buying the deals at cheap. There's enough room for you to have enough extra funded to fund your workout costs. And we'll also talk about and share some of the loan trading platforms that you can start looking at deals today. Not wait 6 months, not waiting 9 months. You can start looking at deals today that banks are already starting to move, that other investors are already trying to sell, that you can start working through, getting your systems in place so that you're a lean, mean, no buying machine in the next 60 days. And we always cover much, much more. Well, like I said, I stay until the last question is answered. Like I said, it's a Cliff Notes, a one-day thing. If you're interested, you can always sign up for our 3-day course. We apply the tuition towards that. But I'd rather have you guys say, let's get started. For some people, I just need a higher learning, I get off and running. Others need a little bit more help in the hand, but we want to make this affordable for everybody looking to learn something, to develop their skills in the next 60 days, get your systems down, understand what you're doing, put in your daily activities so that you can really do a lot of great damage here as the fourth quarter rolls in. And like I said, it's all for $49 right now, half off. Noteweekend.com is the website for you. And we'll throw in some other bonuses as well, too, for you. Other bonuses that we include, or we're throwing over $1,000 in other bonuses. Obviously, the one-day note weekend training is usually $100. We actually throw in a one-day, 4-hour session of me calling banks at a separate time. That's usually $49 by itself, or just watching me call banks live and ask questions, be a fly on the wall. I'll actually throw in the Bauer financial list, the most recently June list, over $360. We throw that in as part of it. That's what it would cost you individually to go buy that list. That lists the banks, lists their default rates, lists the presidents, lists the phone numbers. Okay, $360 by itself. Hey, sign up at $49, you get it included. We'll also include a 30-minute phone call with me after the class. After you go through this one thing is what your next step is. Talk about what your focus is. Do I think that's feasible? Do I think there's opportunities? And kind of get you off and running, point you in the right direction and get you going, okay? We also, that's a $500 usual call because I charge $100 an hour for counseling or consulting. Obviously, we throw in the replays. If you've got a spouse, they can attend for free. That's included. And then we also have a very, very good, well, I would say not good, awesome Facebook group with roughly about 900 plus other note students, investors that are there to help answer your questions, for you to post, to connect, to network with. That's included as well. Like I said, over $1,000 in bonuses for as little as $49. No, not $49 a month. It's a one-time $49 fee there for you. If you sign up for it at noteweekend.com, you can get signed up. We'll get the replays actually to the previous event, so you start watching it now and get rock and roll. So why should you do this? Well, there's always a why. You can learn how to help borrowers and investors out there and have a bigger impact in your community. Because for every foreclosure that takes place, it not only impacts that household, it impacts the neighbors, the block, the zip code, and the city. It's a ripple effect of negativity as prices drop, of numbers and distress increases across the board. If you buy the debt and keep somebody in their house without avoiding foreclosure, you just at least probably save the neighbors at least 10 grand or more in value. I love making money helping people solve problems. Who doesn't want to do this? That's a great way to do it. Being able to do something to really solve issues but make money is a beautiful thing out there. And obviously, if you guys are looking to build wealth, this is the opportunity for that. That's why the banks are always the biggest buildings out there. They're in the note game. They're in the debt game. They're not in the rentals, the fix and flips. They're not in the wholesale business. They're in the mortgage business. They're in the note business. And why would you want to be in that business to build wealth? Cash flow, everybody. That's what it's all about, making things happen. And I'm going to tell you this right now. We all know distressed borrowers out there. For some of you, it might be you on the phone call. Some of you might be on this webinar. Some of you watching the replay may be a distressed borrower, not knowing where to go. Well, I'll tell you right now, this is not a get rich quick. It's a build wealth. And if you can learn this business, you can build a lot of wealth by putting the pieces in place and doing what we teach on a regular basis. And there's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. And I love getting messages. I love getting emails, phone calls from people that we have impacted their lives. They're positive, helping them accomplish big dreams, leaving their job, retiring their spouse, retiring themselves from a job that they hate, moving on, taking a vacation of a lifetime and not worrying about money coming in because it's set up on autopilot with payment streams coming in. And that's a beautiful thing. And so that's why you should do it. Help people make money, solve issues, and really help everybody out there. So once again, everybody, I would love for you to take this journey with me. I would love for you to be one of the 10,000 people that want to make an impact in the world today. Like I said, next 12 months, we're really focused. So this is why we're pricing this ridiculously cheap for you guys and gals out there. And ladies actually have a little bit easier time because it is a male-dominated with the banks. But often it doesn't matter. Like I said, it doesn't matter what your sex is or your age, whatever your skin color is. Nobody gives a rat's ass about that. We are here to make some issues. We're able to solve issues and make a lot of positive things happen. So once again, our one-day note weekend training is a mini workshop. Live stream on Saturday, restream on Sunday. It's a Cliff Notes version of note investing. You get an 18 or 20-page manual. I'm updating the manual as we speak. Always update with new links, other videos, other training that's included for you to understand what's going on. When I say a servicer, what's a servicer? And then you got an hour-long training video on servicing. How am I leveraging the special asset training, or how am I doing that? Get a video along with that as well for you. Hear me call banks or be a part of the bank calling thing. Like I said, it's $49. Love to have you a part of it. If you go to noteweekend.com, you can get signed up for that. It's usually the third Saturday of the month, and would love for you to be a part of it. Are there any questions, comments, concerns from anybody out there? Love to answer those questions before we let you go for the evening here. Once again, noteweekend.com, guys. If after the first hour or two you're like, Scott, I don't like this, hey, I will refund your money back, no questions asked. Don't care. I don't want you to sign up for it if you're not serious about it, if you're not going to take action. If you're one of these guys or gals that signs up for everything, probably not the right guy or the gal. But if you really want to do some things and you want to have an impact, so many people have gotten into real estate investing and struggled to find REOs, trying to find rentals, trying to find properties that make sense. Hey, here's the way we find deals cheaper, faster, and in more abundance than your traditional real estate investors. Hey, come on to the dark side. Come on to the note side of investing, everybody. So encourage you guys. Once again, thank you for being a part of this. Hopefully it was valuable to you. A lot of opportunities in the DC market, a lot of opportunities for you to tap into if you just know how to look and where to look. And that's what we specialize in at Note Weekend. So thank you for being a part of this, and we'll see you guys all at the top, everybody.